Hello everyone, hope all of you are safe and healthy. Welcome to IS Baba's Rapid Revision Series for Prelims 2021. This is session 29 and day 39, and the topics we have are Indian economy, fiscal policy and budgeting. So these are the hot topics we are going to discuss. NFRA, the National Financial Reporting Authority, the e-way bills with the context of GST, and then currency swap facility, then forex reserves, then liberalized remittances scheme, then anti-dumping duty, then equalization levy or the Google tax, and then minimum alternative tax and the alternative minimum tax, the difference between them, and then GST cess or the compensation cess for GST, and then the double taxation avoidance agreement. Coming to first one, the NFRA. Friends, why was it in news? Because Professor R. Narayan Swamy, he got appointed as the chief of the Technical Advisory Committee of the National Financial Reporting Authority. So for this National Financial Reporting Authority, a 7-member Technical Advisory Committee was set up and Narayanaswamy became the chairman of that committee. In this context, the NFRA becomes important, friends. So what is NFRA? NFRA is a monitoring body. It works under Ministry of Corporate Affairs. And then, according to the Companies Act of 2013, NFRA is responsible for making recommendations in accounting and auditing standards. So this is a monitoring body which monitors the accounting and auditing standards and provides suggestions. And then it can investigate matters of professional misconduct by the chartered accountants or the CA firms. So not only chartered accountants and also the firms of chartered accountants. And then impose a penalty and debar the CA or the firm for up to 10 years. So this NFRA also has the adjudicative authority. Yes friends. Then, no other institute shall initiate any proceedings in such matters of misconduct where the NFRA has initiated an investigation. So, NFRA has an exclusive investigative jurisdiction over the cases which it takes up. So, it doesn't want any interference there. So, the NFRA rules, it straightaway says that no intervention shall be allowed by any of the authorities as such. And then central government can refer any other entities for investigation involving the public interest. So any other matters in the public interest, the NFRA can be called for to the investigation. Then more about NFRA. The ICAI, the Institute of Chartered Accountants of India, will continue its role in respect of private limited companies and the public unlisted companies below the threshold set up by the NFRA rules. So, we know that friends, the ICAI used to advise the Quality Review Board in the accounts and auditings in the previous times. Now, due to advent of NFRA, what happens is that the ICAI remains to be the advisor of Quality Review Board, and Technical Advisory Committee, which is newly appointed, it advises the National Financial Reporting Authority. Now, the two jurisdictions are differing in such a way like the ICAI and the Quality Review Board, they look after only those companies which are not listed in the stock exchange and which are private limited companies, and those small companies which are below the threshold prescribed in the rules. So the threshold may be like 500 crores of paid up capital, then 1000 crores of turnover, etc. And above the threshold, all the big companies and those companies which are already listed in the stock exchange, those will be reviewed by the National Financial Reporting Authority under the guidance of Technical Advisory Committee. So this is all about the change in the jurisdiction between ICAI and the Quality Review Board and the NFRA and the Technical Advisory Committee. Then the NFRA is composed of one chairperson, 3 full-time members and 1 secretary. So totally 4 persons and 1 secretary. And then the chairperson shall be a person of eminence and appointed by the central government. So the chairperson shall have such expertise in auditing and accounting, and he shall be appointed by the central government. So this is all about NFRA. Then coming to next, the e-way bill. Friends, we know that e-way bills will often be in news when the finance ministry comes up with a report that whether e-way bills have been increased or decreased, whether the income from e-way bills have been reduced, improved, etc. time to time. So that is why e-way bills are eternal or maybe perennial. Then the key points regarding e-way bills are: the e-way bill or the electronic way bill is a document to be generated online under the GST system. Yes, we all know that. And then when the goods of value of money more than 50,000 are shipped via trade by interstate or intrastate. So when we are trading a goods worth more than 50,000 either interstate or intrastate, we have to compulsorily have a e-way bill. And then the e-way bill must be raised before the goods are shipped, not after the goods are shipped, before that. Then it should be including all the details of goods, their consignor or the shipper, the recipient, whom to reach, and then the transporter who carries. So all the names and all the destinations where and all the goods goes will be written in the e-way bill in advance. Then GST e-way bill is expected to trim the logistic cost by 20%. So friends, we know that we will have a track record of e-way bill even before it starts shipping. Now, what is the advantage is that every time these drivers, they need not stop in the check post, they need not show the consignments, they need not open the goods and show that we are not smuggling anything. All those things will not be there. It will save so much of time, diesel, money, etc. And then it can be generated via e-way portal and even by an SMS. So in the next slide we will show what is an e-way bill. And then a consignment can be intercepted at any point of time for verification of e-way bills. So you need not be stopped at the check post itself. So the inspectors, they can stop you at any point of time in order to check whether you have an e-way bill or not. Then if a consignment is found without an e-way bill, a penalty of up to 10,000 rupees or tax sought to be evaded, whichever is greater can be levied. So how much tax you are going to evade by avoiding the e-way bill? Or rupees 10,000, whichever is higher, that money you will have to pay as a penalty. Then more about e-way bills. So in the figure we can see this is an e-way bill. So here we will be having the name of the shipper, then name of the destination, etc. Friends, this is similar to the income tax report, the ITR which we file now, the same way it is. So you can see in the website the e-way bill system and you can learn more about it. Now, what are the advantages of an e-way bill? So eliminating the time spent on interstate checkpoints. Yes, we have discussed this. And then e-way bill helps in reducing tax evasion. How? Since every e-way bill generated by both sender and buyer, it has to be uploaded while filing the GST returns. So in both the receivers and senders GST return, the same amount of money should be returned and the same should be shipped. So if there is any discrepancies, then it is an indication that tax evasion is taking place. So in this way, e-way bills will curb the tax evasion. Then in the previous tax regime, tax official had to manually cross-check the e-way bills. So now with the e-way bills, this manual cross-check has been abolished. So now the official can check the e-way bills via online, so they need not go and check on the spot. Then electronic e-way bills, they are single e-way bills for movement of goods across the country. So this saves a lot of paperwork. And then improvement in logistics performance index. So as the time and money is saved via movement of logistics, it improves the logistic performance index. Then it also increases or improves ease of doing business in India. And then it may increase the government revenues by 20%. So via avoiding tax evasion, by decreasing the wastage of time and money, the government's money will be saved by up to 20%. So this is all about e-way bills. Then coming to next, the currency swap facility. Friends, why was it in news? Because recently Bangladesh Central Bank has approved a 200 billion currency swap facility to Sri Lanka. Friends, we know that from last 4 to 5 years, Sri Lanka is suffering from some financial losses, and Sri Lanka had also approached India for the currency swap facility. And in 2020, Reserve Bank of India had agreed to a 400 million currency swap facility for Sri Lanka till November 2022. So in this context, the currency swap facility becomes important. So friends, in crude, what is a currency swap facility? It is an agreement involving financial transactions in the mutually agreed currencies. So this is the simplest possible definition for that. So any import, export or any lending or borrowing which will take place on the agreed currencies. So for example, if you take the currency swap between India and Sri Lanka, it is said that this 400 million will be given by RBI via US dollars. And then Sri Lanka will give back by November 2022 the same $400 million in Indian currency. And moreover, Sri Lanka will give back the money at the 2020 exchange rate, not the 2022 exchange rate, friends. So at the previous date's exchange rate, the money will be returned back. So while doing this, Sri Lanka will save itself from the currency volatility or the exchange rate volatility. So this is how Sri Lanka or any other nation, they save themselves from unnecessary exchange rate volatility and they can come out of their financial losses. Then RBI has some of the policies for currency swapping. What are they? RBI can offer credit swap facilities to SAARC countries within an overall corpus of 2 billion. So 2 billion corpus has been set, and within that it can award currency swap facility to any SAARC countries. Then the SAARC currency swap facility came into operation in November 2012. So it is a long back thing. Coming to the aim of this facility, it is to steer clear the short term foreign exchange volatility, and then to infuse liquidity requirements, and then to resolve the balance of payment crisis of the nations. So these are the aims and this is the broader policy. Then coming to next, forex reserves. Friends, why was it in news? Because as per Reserve Bank of India, India's foreign exchange reserve has surged by 5 billion to 609 billion in the week ended by 25th June 2021. So by this date we have 609 billion of forex reserves. So we will get into the details of forex reserves and the progress. Foreign currency assets or FCA, it rose by $4.7 billion to $566 billion. So approximately it has increased from 562 to 566. Then gold reserves rose by 365 million to 36.296 billion. So even in the gold reserves we have a marginal increase. And then the special drawing rights with the International Monetary Fund, it has been remained unchanged at SDR 1.498 billion. So this has remained unchanged. And then the country's reserve tranche with the IMF increased marginally by $1 million, and it is now at $4.965 billion in the week. Now friends, what is the IMF SDR and what is the reserve tranche? So many times you confuse between the two. We will discuss this in detail now. Friends, what is the reserve tranche of IMF? So reserve tranche of IMF is a deposit saving account like thing. So when you are having 4.965 billion in the reserve tranche, it is that these much of dollars are already present and you can take them and use it whenever you are required. But however, SDR is not a bank account. Then what is SDR, friends? Many people say that SDR is a currency, but they say it is not an actual currency. Many people say SDR is a bank balance or a potential bank balance. So with all these intricacies, why are they haunting SDRs? So friends, we will discuss in detail. So SDR can be said as a IMF's currency in crude. But however, these SDRs, they don't work the way the other currencies work in the market. So in the crude we can say that they are IMF's currency. So how are they determined? How are they calculated, friends? They are calculated as the weighted average of the hard currencies. So we know there are 6 to 7 hard currencies and their weighted average is the SDR. Now one SDR will be having different value for different hard currencies. So in the IMF website, as per July 1, 2021, these are the values for one SDR. So one SDR means 1 US dollar and 1 SDR means 6.47 yuan of China, then 1.186 euros or 111.45 of Japanese yen. So likewise, as it is the weighted average, different currencies they get different values for SDR. And now how this SDR works? Friends, we said that we have 1.498 billion SDRs in forex reserves of India. So friends, now I want to purchase an oil of worth 1 billion from US, but I don't have hard currencies. So now what I do, friends, I take this 1 billion of SDRs. So I know that 1 SDR is equal to 1 US dollar. So when I give 1 billion SDRs to US, it is akin to I am giving $1 billion for US. So now what happens? My forex reserve will come down to 0.498 billion. You agree with me? Yes, friends. And now when this 0.498 billion is the current holding of Indian forex reserve, but the cumulative holding is the 1.49 billion. So I have an obligation to replace this 1 billion as soon as possible. But if I don't replace, until I replace it, until I make it to 1.498 billion, I will have to pay 0.05% for every SDR I have taken out of this forex reserve. So this 0.05% is the SDR interest rate. So I hope you are clear with the SDRs now. This is like a credit card. So you have this much of eligibility to take the credit, you take it and replace it. If you don't replace, you will have to pay the interest. So I hope you have understood. Coming to next. Significance of rising forex reserves in India. So comfortable position of the government. So if there are more forex reserves, India can manage the internal and external financial issues in a better way, and then managing crises. So this increased forex reserve, it serves as a cushion in the event of balance of payment crisis, the way it did in the 1991. And then rupee appreciation. The rising reserves have also helped the rupee to strengthen against the dollar. How does this happen, friends? Friends, we know that in India we have a excess of foreign currency assets. We saw it in the last slide. So now foreign currency assets are in excess in India, and now the demand for foreign currency asset is not so much. So when the demand is less and supply is more, the foreign currency assets are not costlier. For example, US dollar is no more costly for India. So what US dollar was 70 rupees per dollar is now 60 rupees. So the dollar has become cheaper, or in other words, Indian currency has appreciated from 70 to 60. So that is how when the foreign currency assets rise in the forex reserve, our currency will appreciate automatically. And then confidence in the market. Yes, if there is a huge buffer, then investors and consumers, they can trade with utmost confidence. So this is all about forex reserves. Coming to next, the liberalized remittances scheme. Friends, why was it in news? Because India has witnessed its highest ever monthly outflow of 1.69 billion under the liberalized remittances scheme in July 2019. So in this we can crudely understand that liberalized remittance scheme is a window wherein we can invest our money abroad, and this is the liberalized way of we investing abroad. So what is all about liberalized remittance scheme? This is the scheme of Reserve Bank of India introduced in 2004, and here all resident individuals including minors are allowed to freely remit up to US dollars of 2,50,000 per financial year. So for one financial year, the cap is 2,50,000 US dollars. So this much I can invest individually for any permissible current or capital account transactions. So current or capital, anything is possible, and even both are possible. And then what is the non-eligibility? The scheme is not available to corporations, partnership firms, Hindu undivided families and trusts, etc. So only for the individual accounts this is allowed. And here these are the places where we can invest. So private visit to any country, then gifts and donation we can give, then going abroad for employment we can go, we can emigrate by using that money, and maintenance of close relatives abroad, and then travel for business purposes, then studying, then medical treatment. For all these things we can use the liberalized remittances scheme window, and we can spend the money abroad. And then coming to more about LRS, or the liberalized remittances scheme. So these are the permissible expenditures under the capital account. So opening foreign currency account, then purchasing property overseas, then making investments in mutual funds, then acquiring shares, debts and debentures, then setting up joint ventures, etc., then giving loans, gifts to NRIs, PIOs, relatives and others. Then come to next, the prohibition under transactions. So what are the things that are prohibited under liberalized remittances scheme? They are purchase of lottery tickets, gambling, then proscribed magazines. What are proscribed magazines, friends? Those are forgeries, then plagiarized magazines which have a copyright violation. And then trading in foreign exchange abroad. So you can use this exchanged currency only for the personal use, not for trading it abroad. And then capital account remittances directly or indirectly to the FATF banned country. So we know that this FATF banned country, they will be engaged in terrorist activities, in drug smuggling, human trafficking, etc. So we cannot remit to these nations. Then remittances directly or indirectly to those individuals and entities identified as posing a significant risk of committing acts of terrorism. So you cannot remit to those entities which are being suspected of committing acts of terrorism, organized crimes, etc. So this is all about LRS. Coming to next, the anti-dumping duty. Friends, more often than not, we hear in the news that India is being levying anti-dumping duty on the Chinese products, etc. So, that is why it will be in news always. So, here we try to understand what is anti-dumping duty or what is anti-dumping. Friends, before that, we should understand what is dumping. Friends, dumping is a process wherein a company exports a product at a price that is significantly lower than the price it normally charges in its home country. So, in its home market, whatever it charges, below that it will export to other nations. So, this is the dumping. Then, the anti-dumping duty is a protectionist tariff that a domestic government imposes on foreign imports that it believes are dumped. So, if the nation finds that something is being dumped, then it will levy an additional duty so that the rates will be equalized. For example, consider a Chinese flask. So, in China, it might be 40 rupees equivalent, and in India it might be 20 rupees. So, now when India comes to know that this 40 rupees is being sold at 20 rupees, so this hurts our Indian made flasks which are at 60 rupees. So, we levy an anti-dumping duty of 40 rupees so that this 60 will be equaled. Then we have one more tax, friends, it is called countervailing duty. So, how is a countervailing duty different from an anti-dumping duty? So, countervailing duty, also known as anti-subsidy duties, are the trade import duties imposed under WTO norms to neutralize the negative effects of subsidies. So, here the countervailing duty takes care of subsidies. So, what is the difference, friends? So, in the Chinese flask, we know that 40 and 20 rupees was the issue. But now coming to 1 kg of oats. So, now I have to purchase 1 kg of oats. Friends, in India 1 kg of oats is 80 rupees. But in US the same 1 kg of oats is 40 rupees. And now when you import this US oats to India, it will be 45 rupees. Even then this is much cheaper. Why it is cheaper, friends? Because in US huge agriculture subsidy will be provided. So, because of that subsidy the oats will be much cheaper, and when this is imported to India, this 45% will be sold readily, this 80% Indian indigenous oats will never be sold at all. So, in order to avoid this, what the government does is that it levies a countervailing duty of 40 rupees on this. So, now this becomes 85, and now the 80 rupees oats of India will be sold off. So, this is the difference between anti-dumping duty and countervailing duty. Then come to next, the equalization levy. Friends, equalization levy is also called as Google tax or digital tax, whatever you call it may be, but it was in news long back in 2016. But once again it is in news because Joe Biden, he spoke of minimum taxes for digital sector. So, in every nation we should have a minimum tax levied on the digital sectors. So, in this context this equalization levy or Google tax will become important. So, now it was introduced in India in 2016 with the intention of taxing the digital transactions. Yes, we discussed that then, to prevent the technology companies from shifting profits offshore to tax havens. So, in order to avoid the shifting of profits, this equalization levy will be levied. And then the following services are covered: the online advertisements and any provision of service through the virtual channel will be included under the equalization levy. And then applicability. Equalization levy is a direct tax which is withheld at the time of payment by service recipient. So, at the very time of payment, this equalization levy will be deducted. And then the two conditions to be met for the liability are: the payment should be made to a non-resident service provider. So, there should be cross-border payment. And then the annual payment made to one service provider should exceed rupees 1 lakh in one financial year. So, the payment should be huge and it should be cross-border. So, the equalization levy will not be levied for 5 rupee, 10 rupee transaction and all. So, we will discuss with an example, you will understand better. Friends, now IAS Baba, it will post an advertisement on Amazon's website. So, IAS Baba is an Indian company, it will post an advertisement on Amazon website. So, now IAS Baba has to pay some 1 lakh rupees for this advertisement, and it pays 1 lakh rupees. But now in India the service tax is 18%, but in US the service tax is 8%. So, now what this Amazon does is that it says to the US officials that this 1 lakh I have earned from the US branch, not from the Indian branch. So, that is why instead of paying 18%, it will pay 8% of tax. So in order to avoid this, what Government of India does is that it checks whether the transaction is cross-border. So now IAS Baba system which makes the payment, it will be having the IP address of India. Then Amazon receiver who receives the payment, the system which receives the payment will be having an IP address of US. So now there is a transaction of rupee 1 lakh from a Indian IP address system to US IP address system. So now automatically 18% of tax will be deducted. So this is tax deduction at source for digital services. We can think like that as well. So I hope you have understood with the example. Then coming to next, the minimum alternate tax. Friends, recently Finance Ministry has amended the MAT rules. So in this context, it becomes important. So what is MAT, friends? So it is an alternative tax paid by the zero tax companies. So what are the zero tax companies, friends? Zero tax companies are those companies which have got a complete 100% rebate over their taxes. So these are not paying any taxes because they have got complete rebates. So if I am paying 15% of taxes, 5% rebates for insurance schemes, then 5% rebates for labor welfare schemes and 5% rebate for MSME status. So all the 15% is rebated. I am not paying any tax. I am a zero tax company. But however, the government sees my company and it observes that I am continuously making profits. So now when I am continuously making profit, why should I not be levied any other taxes? So in that context, government will levy a 15% of alternate tax on me. So irrespective of rebates, you will have to go ahead and give the alternative tax, and that is 15%. And this is over and above the cesses and surcharges. So above this 15%, the cesses and surcharges can also be levied. So in other words, minimum alternate tax is those tax which are being levied on the zero companies which are making continuous profits. So when you are making profits, why don't you pay something for the government, man? So this is what the question the government asks. And then if you are trading in the convertible foreign exchanges, 9% of minimum alternate tax will be levied. So friends, this continued for some years and later this was extended to individuals as well. So now the alternate minimum tax is levied on individuals. So this provision is relating to the non-corporate taxpayers. And friends, moreover, this AMT is not only applicable for individual, it is also applicable for Hindu undivided families or any associations for that matter, or maybe even the self-business enterprises. So anyone who is having complete rebates but who is making continuous profits, they will have to pay either MAT or AMT in India. And once again, AMT is levied at 18.5% of the adjusted total income. Or if you are trading in convertible foreign exchange, you have to pay 9% of your adjusted total income. So this is the difference between MAT and AMT. A simple difference. We will move on. Coming to next, GST cess or the compensation cess. Friends, why was it in news? Because at the very advent of GST, central government had promised some compensation for the state governments if they are making losses in the GST. But however, in the wake of COVID-19 situations, central government is unable to pay this compensation. So in this context, the GST compensation will come into picture. So now, what is the GST compensation cess? As a part of GST reforms, this cess has been introduced through GST Compensation to States Act 2017. So this is a statutory clause, and then it is levied on interstate and intrastate supply of goods such as aerated drinks, coal, tobacco, automobiles, etc. for 5 years. So some 2% of GST compensation cess is levied on these sin goods or the luxury goods for 5 years, and this cess will be deposited to a fund called compensation cess fund, and the compensation will be provided from this fund. So this is how the compensation had to work. And then the proceeds will be distributed to the loss incurring states on the basis of the prescribed formula as per the compensation. So the formula will be set by the GST Council. Then why the GST cess? We spoke once again that it was assumed that GST revenue of each state would grow at 14% every year from the advent of GST. But however, if some of the states are not experiencing this 14% growth, then they will have to be paid with the cess. and then the state that had collected tax less than this amount will be amenable for the collection of this GST compensation, and then this scheme will be valid for 5 years till June 2022. So this is all about GST cess or GST compensation cess. Once again, not a difficult concept. We move on. Then come to next, double taxation avoidance agreement. Friends, why was it in news? Because recently Finance Ministry has said that NRIs and foreign nationals stuck in India due to COVID-19 pandemic and who are struggling from the threat of double taxation, they can submit the details to the income tax department to avail relief. So if you submit the details, you will get the relief. Friends, this is mainly due to the work from home thing, wherein the NRIs, who are the employees of foreign companies, they are working from home from India and they are facing the threat of double taxation. So that is why the Finance Ministry came up with this initiative. Now, in this context, what are the other features of double taxation? We will study here. Friends, before double taxation avoidance agreement, we should have a financial exchange. So some of the clauses or some of the treaties, they provide financial exchange between two nations. For example, the FATCA or the Foreign Account Tax Compliance Act of USA, it will provide for financial exchanges. So now when the Finance Ministry is asking for detail, it will exchange this information with the US or other nations. Yes friends, then we also have multilateral competent authority agreement on automatic exchange of financial account informations. So once again, this is also for tax evasion and also for double taxation avoidance as well. So here when there is automatic exchange of information, then there will be least possibilities for tax evasion and there will be least possibilities for hiccups or misunderstandings in the financial information exchange. And this is a 107 countries grouping and India had signed it in 2015 in Paris. And then we have OECD's base erosion and profit shifting. Once again, this also allows for financial information exchange. So friends, it is all about coordination, collaboration and cooperation in financial informations that can stop the tax evasion that is going on, and it can also resolve these double taxation issues. So this is all about double taxation avoidance agreement. Then coming to the last part. Friends, one great perspective which I want to share with you is that the preparation of UPSC is itself a national service. Friends, if you get selected, you go on to become the builder of the nation, or if you don't get selected, you help the strongest to go on to build the nation. So you help effectively in filtering the candidates. So both the ways you are serving the nation. So don't worry about the success or results. Don't worry about the fruits of your action. Just worry about the action and perform your action with utmost sincerity and success will be yours. All the very best friends. Good luck.